Good morning, everyone. Welcome on to this Saturday morning. So the purpose of we all here today is to talk to you, all of you, about Ind AS 116. Ind AS 116, as you know, is an accounting standard which talks about leases. So just a quick introduction of myself. So I'm Sandip Khetan. I lead the accounting advisory practice for EY in India, and the purpose of me being here is to help you understand some of the nuances as you prepare for your CA finals. So our idea is to share knowledge, and also I'll be looking forward to have your questions, your feedback. We also have a plan to run a quick contest. So we'll have 10 questions, and you can participate, and then winners will be provided with the prizes, which of course we will courier to you. There is no immediate ceremony. We will definitely send it to you to your addresses. And if you have any questions as we progress during the course of the deliberation, feel free to raise your hand, and we will possibly invite you to ask your question. I've kept it brief. It's not that I'm going to cover the whole standard, but the idea is to talk to you at a high level, and then help you understand some of these concepts, and then take questions. So Ind AS 116 is a standard which in a way redefines how do you do lease accounting. And I presume that most of you understand what is lease, right? And the fundamental of lease is that there has to be a presence of a tangible asset. Okay, so we are talking about tangible asset, so lease accounting is not applicable, for example, for intangible assets, so to say. Okay, and we're going to talk about intangible assets. So there has to be a presence of a tangible asset. Okay, and that is, let's say, land, property, plant and machinery, vehicles, equipments, so on and so forth. So there is a person who is in possession of the tangible asset, and there is a person who's in need of that asset. And then both parties come together, where one party agrees to let the other party use their asset in compensation or consideration as mutually agreed between both the parties. And that is, in a way, results into a lease transaction. The fundamental of the lease transaction is there is no transfer of ownership. Okay, there is no transfer of ownership between the lessor and the lessee. So we need essentially two parties for any arrangement to be qualified as a lease arrangement, which is presence of a lessor, the person who owns the asset, and the lessee, the person who's going to use the asset. A very simple example is let's say, if you're staying on rent, right, and you take a property on rent, that is nothing but a lease arrangement which you have entered into with the landlord. So just give me 1 second. Okay, sorry, there was some noise which was happening in the background. All right, so I'm going to move to the next slide to help you understand the nuances here. Just give me a second. All right, thank you. Sorry. So what is a lease? Now, if you see the slide, this slide summarizes that what is a lease. And if you look at the scope out, which is what I was trying to explain, that lease to explore for or use minerals, oil, natural gas, and similar non-regenerative resources. So which are covered in Ind AS 106. Similarly, what is covered in Ind AS 41 on agriculture, services, things which are covered under service concession, or things which are covered under Ind AS 115 on revenue recognition, or Ind AS 38, which are intangible. So anything which is covered in other accounting standard, or which is not a tangible asset, so to say, is not covered within the scope of this standard. And for an arrangement to qualify as a lease, it's a contract which conveys the right to control the use of an identified asset for a period of time in exchange of consideration. So just going back to my same example of of a house property which you're taking on rent from your landlord. If you just think about that transaction, it is, let's say, a house which you're taking on rent, let's say for a period of 2 years, and in exchange you're paying him rent, say 20,000 rupees per month. So 24 installment for 20,000 rupees per month is the total consideration, in exchange of which he's letting you in possession of the house property. So you have a right to control the use of the property for the period you've agreed to pay to the lessor or the landlord in this example. The two fundamental requirements here is the presence of an identified asset, as well as the customer has the right to control the use. So the asset has to be identified. I think that's very important. And as I said, many common example which I just talked about, whether it is land, building, equipments, property, plant and machinery, vehicles, which are very common form of leases, is what we see. And that identified asset, you should have the right to control the use of that identified asset. Many times it is a situation that it is not explicitly, or it may be implicitly specified. What does that mean? That there is actually a larger arrangement in which the asset is not identified per se, okay, directly. But essentially what it means that you have to then look into the substance of the arrangement, okay, and to say that whether an asset is identified, whether there is an identified asset which is going to use only for my purpose, right? From that perspective. So let me give you a very simple example. Let's say you enter into an arrangement where you say that I'm going to purchase power, right? At the rate of rupees 5 per unit from whatever is generated from your power plant. So the agreement is to purchase the power, and you have not entered into an agreement to rent the power plant in itself. But when you go into the substance of the arrangement, it turns out that you are the only beneficiary, or you're the only person who's going to take the entire output from that power plant. So the underlying asset is the power plant, which is being used to generate the power which you are going to purchase, and the entire output is actually reserved for you. So essentially, you control the use of that asset, and the asset has also been identified in your scheme of thing, and hence there is an asset which is implicitly identified and not explicitly identified or stated in the contractual arrangement between the lessor and the lessee. And we do see some of these arrangements more often than not. And then you will see the other thing which is very important is no substantive substitution right. So a very common example, let's say you enter into an agreement with a fleet service provider or a transport service provider, and he says that, I'm going to provide you a car every day for your requirement, right? Now you enter into this arrangement. So person is going to provide you a car every day to meet my requirement. Now, the fundamental thing you need to remember here, if there is the same car which you have agreed that will come and pick you every day and drop you every day, and that car is only going to be used for your purpose, then that is a lease arrangement. But if the fleet owner can send you today a Maruti, tomorrow a Hyundai, and day after a Mahindra, and day after something else, or within Maruti he can send you multiple cars of Maruti, so on and so forth, that means what? That the lessor or the service provider actually has a substantive substitution right. That means it is not a lease arrangement, because there is no identified asset which has been in control by the lessee. So the asset has to be very unique. For an arrangement to qualify as a lease arrangement, the asset which has to be identified has to be very unique and has to be in control of the lessee, from that perspective. So that's what we need to remember as you look at the lease arrangement between the lessor and the lessee. And the lessee should have all the right to substantially all economic benefit. The lessee should have the right to substantially all the economic benefit or have the right to direct the use. So all of these is what you need to keep in mind as you look at this whole definition of leases. Has to be an identified asset and should have the ability to control the use of the identified asset. Asset could be explicitly or implicitly specified, and there is no substantive substitution right. And I have the, as a lessee, I should have the right to obtain or direct the use of that asset, from a lessee perspective. So all of that is what will determine that who controls the use of that asset and whether that's a lease arrangement or not. So we have in the bottom what you see, example of identified assets: specified car, truck, ship, aircraft, servers, networks, retail unit identified in the contract, or premises for installation of telecom equipment, etc., etc. So multiple example is what we see, and that's a new kind of standard. The thing is, further again, you need to look at, there's a flow chart here to say that is there an identified asset, and you can go through this decision tree to say that does the customer have the right to obtain substantially all of the economic benefit from use of the asset throughout the period of use. So I, as the customer, I'm the lessee, do I have the benefit to use this asset throughout the period of use? If the answer to that is yes, then that is a lease arrangement. If the answer to that is no, that I don't have the right, then you go and say that this is not a lease arrangement, right? Similarly, you got to look at the scenario to say that do I have the right to direct how and for what purpose the asset is. So I'm not using it because I'm not in, I don't know how to use it, but I can hire people to use it, right? So I'm able to hire people to use the asset. If that been the case, then also this is a lease arrangement, in that sense. So you got to look at that. If the answer to that is yes, that I can direct them, then also it's a lease arrangement. Then you look at, no, it is neither. I can right to operate the asset throughout the period of use without the supplier having the right to change those operating instructions. So again, you go through this decision tree. And for you to evaluate that whether are you in control or are you not in control? Do you have the ability to direct the use of the asset? If the answer to that is yes, then that qualifies as a lease arrangement. So I'm going to pause here and say that if you have any questions, anybody wants to raise hand, and I want to ask question to say that, are you principally clear that what is a lease arrangement before we get to discuss that how do you account for the lease arrangement under the new framework? So if you have any question, I'm happy to take those questions and give you my perspective on that or answer your queries. Praveen, let me know if you see any question from anyone.
Right. So far, there is no question. Guys, you can also type your question in your chat box, and then I'll speak your name and you feel free to interact with Sandeep. So far, no question, Sandeep. I think then we can move on. Yeah.
Awesome.
Sandeep, sorry to interrupt you. So there's one question from C30. I request you, the person who has asked the question, if you can also write your name.
But that's okay. Why don't you ask him to ask me the question so we can
please start your video and unmute yourself, and you can ask your question. So the question is, will it qualify for leases if vendors substitute the same assets as mentioned in the contract due to any reason?
Right. So it depends actually. So we have to see if whether as you see the question was that whether the substitution right is substantive in a way. So in what all scenarios you are allowed to substitute. So there, it's not that I can send you, as I said, a Maruti let's say Desire today, and tomorrow I can substitute this with another Desire of another registration number, another chassis number, so on and so forth. Okay, unless actually the existing car which I had leased to you, there is some fundamental problem with that, and only during that intermittent period or the period of disturbance, actually I'm replacing it with another Desire. So the asset has to be identified. It has to be the same asset, right? And it can't be just replaced with another similar asset for that arrangement to qualify as a lease. So if I have the right to send you any Desire any day, for example, in my example, then again, that is not a lease arrangement. So substitution right is something which is only to be exercised by the lessor only in very, very limited situation, and which is not, let's say, inherent part of the arrangement, so to say, and it can only be exercised in a very limited scenario for that arrangement to qualify as a lease arrangement. I hope that answers your question. Do we have any other question?
No. So Aditya, if you have a
Sandeep,
question, you can.
so there's
Yeah.
one more question, Praveen.
Yeah.
If you can, read the same for Sandeep. And Sandeep, there's a request if you can go back to the previous slide.
Okay.
Right. Vishal, you can unmute yourself and ask your question.
Yeah. Hi, Sandeep.
Hi.
So I have a query. Suppose, as you rightly mentioned, that in the case of power, when the lessee takes the substantial output, it will be classified as an implicitly lease. So suppose a lessee takes a machine on lease, but the actual machine which the lessee will get is not specified in the contract. So will it also come under implicitly specified, or it will be explicitly specified?
So when you say the lessee takes the machine on lease, but the machine is not specified in the contract, what does that mean?
Means suppose the machine, it knows that that this machine, I'll get a machine on lease, but which actual machine which I'm getting on lease, suppose there are in the machine there are 4-5 codes, A1, A2, A3, A4, but I'm not knowing the which machine actually I'm getting. So will it be coming under implicit or explicit lease?
So once you've taken possession of the machine, right?
No, I've not taken the position.
Then you are saying I can take output. So there has to be a purpose for you to get into this arrangement, right? So machine, you want to draw the output from the usage of the machine.
Yeah.
And you are saying that the same output I can actually draw on day 1 from machine A, day 2 from machine B, day 3 from machine C, or vice versa. I can actually, there is an assembly line, and I can use any of the machine on any of the days I want to come, and I can draw the output. Is that what you're trying to say?
Yeah, right.
It's not a lease arrangement. Then it's again a service arrangement, which is the same thing, right? I have a fleet of cars which are lying in my warehouse, and anybody can walk in and can pick up a car for a day, returns this car. Next day he wants to come in, he can pick up another car. Then that's not a lease arrangement, that's a service arrangement. The asset has to be unique for an arrangement to qualify as a lease arrangement. The asset has to be unique. It is not something which I can replace just like that.
Yeah. Okay. Got it.
All right.
Thank you.
Okay. Is there any other question, guys? Okay.
Purvangi is asking a question, Sandeep.
All right.
So she's just making a comment. So in this case, we don't have an identified asset.
Yes.
Right.
Since we don't have an identified asset, it doesn't qualify as a lease arrangement. Absolutely. Bang on.
Okay. Thank you.
All right. So now we've understood the basic definition of lease arrangement. So there has to be two parties in a lease arrangement, as said, the lessor and the lessee. And then there has to be an identified asset. That's requirement number 1. And the requirement number 2 is that I should have the ability to control, right? The right to use the asset, or control the use of that asset, and control can be demonstrated in two particular ways. Is that when I'm the one who's going to consume the entire output, or the entire beneficiary from the use of that asset, or I have the ability to direct the use of that asset. So that demonstrates the control. And from an asset which is identified is been defined as it could be explicitly identified or implicitly identified, and there should not be any substantive substitution right available with the lessor, from that perspective. So if all these conditions are met, then that is a lease arrangement under the new standard. The definition is substantially, I would say, more or less stays the same as what we had under the existing standard. But in few complex scenarios, we may see an answer may kind of differ. But in 95% of the scenarios, answer possibly of whether an arrangement is a lease or not stays the same under the existing standard versus the new standard. All right. Now we move to how do you now account for a lease arrangement? So now we've understood that this is a lease arrangement. Now, how do I account for the lease arrangement? And if you remember historically, the way under the existing standard Ind AS 17, right? The lease were understood as finance lease and operating lease. Okay, that was the two way you were looking at any lease arrangement to say whether it's a finance lease or whether it's an operating lease. Now, this finance lease or operating lease this concept has been done away with in the new standard. It's no longer applicable in the new standard. It is only applicable from a lessor standpoint perspective. Okay, so the accounting for lessor has not changed substantially. You know, there are few changes from a lessor perspective, but it has not changed fundamentally under the new standard for lessor. Now you get to the lessee, right? That is where the accounting for lessee has changed fundamentally into the new standard. Now the lessee accounting is that you have to look at all the arrangement as like a finance lease arrangement. Okay, essentially all the arrangement from a lessee perspective will result into recognition of a right of use asset and an obligation in your financial statement. So what you see here, that lessee accounting will result into recognition of right of use asset and an obligation, which is a liability. Both of this will result into recognition in the financial statement of the lessee at inception of the lease arrangement, because now the standard says that you've entered into this contractual obligation, and since you've entered into this contractual obligation, you need to record your assets and liabilities and then do the depreciation or amortization of that asset and do the unwinding of that liability, as a result of which what you're going to see in the P&L is the depreciation and the interest charge, you know, from that perspective. So that's what you will see in the P&L, is the depreciation and the interest charge, whereas in the balance sheet you will see the right of use asset and right of use liability, and we will quickly talk about how do you need to compute all of that. So what is the meaning of right of use asset? Right of use asset is present value of lease liability. So in my example of this landlord, right, you entered into arrangement, going to pay for 24 months at the rate of 20,000 rupees per month. So you're going to look at all of that. You're going to look at all of that. All right. So what I was trying to say, that you're going to look at the present value of the future lease payment, which were due. Then you're going to look at the what was the initial direct cost, right, which you have incurred under the arrangement. Slides are not visible, right? I'm just waiting for the power to come back. Tanvi, just kind of bear with me. So then the right of use asset, okay. So you got to look at all the installment which I need to pay over a 12-month period. Is there any initial direct cost which I have incurred? Is there dismantling cost which I promised to be incurred at the end of the period of the lease? Is there any lease incentive which I'm going to receive, right, from the lessor? All of that is what I need to put together to say that is what is going to qualify as the lease asset, right of use asset, right? And similarly, you will have to then compute what is my right of use obligation, from that perspective. So that's how you will be able to compute the right of use asset and right of use obligation, from that perspective. So just give me a second. Power is back, so I'm just settling this in. Yeah.
Yes, we can see the screen.
You can see the screen?
Yes.
Okay.
And
that's fine. Is this all good?
Yes.
Hi Sandip, Furkan this side. I'm sharing this screen. If you want, I can stop it if the power is back.
Yeah, okay. Yeah, Furkan. That is why I think there was double screen share.
So I've stopped it. You can share it now.
Okay. Share. Yes. Can you see
it? Yes. And Sandip, requesting you if you can also stop the annotation from the top menu.
Okay, that's fine. Yeah. All right. So I have to get used to this technology better, huh? Right. So I think guys, are you clear on what I was trying to say on the right of use asset, present value of lease liability? Then you got to look at the.
Sandip, sorry to interrupt. So we are on the slide share. We are not on the slide share mode, so we cannot see. Yeah.
You can't see.
We can see Sandip, but we can see the presenter view, wherein the other slides are also coming.
Right.
Okay. So I should say stop share. Sorry, guys. I will do this. Cancel. Is this better?
We cannot see the screen.
Okay. So why don't you share, Furkan, instead of
Yeah,
me
boss,
trying
I'll
to
do it. I'll do it.
cover this? Okay, better. So I hope everybody can see the presentation now, right?
Yes.
So we have the right of use asset, which is present value of lease liability at the as the initial direct cost, reduced and also at the dismantling cost, prepaid payments, and less the lease incentive received. That becomes the right of use asset. And similarly on the lease liability, so in the balance sheet, whatever I need to pay, I should record as a lease liability, which is fixed payment plus any variable payment which is linked to index, and then if there is any exercise price or a bargain purchase which I have at the end of the day, if there is any penalties which I need to pay, if there any residual value guarantee which I need to pay, all of that put together becomes your lease liability. So the important thing is now for you to remember is that for all lease arrangement, a balance sheet asset and a liability is required to be mandatorily recorded, which under the existing scenario was in an operating lease, it was considered as an off-balance sheet transaction. So that is now no longer possible under Ind AS 116. So that's the fundamental change which has happened under Ind AS 116 as compared to Ind AS 17. So all lease arrangement now required to be recorded as part of financial statements.
Sandeep, we are getting a question.
Yeah, I will take that question. So we move to the next slide.
Okay.
I think there are a few questions. I can see now the chat box much better.
Right.
So
Amood.
yeah, let me see. I have a question from what discounting rate we need to use for the present value. Okay, so discounting rate, what you use for the present value is if you aware of the discount rate which is used by the lessor, okay, which is what is called the discount rate, which is implicit in the lease arrangement. If you know that, then that is the discounting rate is what you will use. If let's say that is not aware, you're not aware, then you're going to end up using your incremental rate of borrowing. So more often than not, we see that you'll end up using your incremental rate of borrowing for the purpose of discounting, both for right of use asset and obligation. So that's the very common practice is what we see here. So let me take this example, which is entity Y and entity Z execute a 12-year lease of a rail car with the following terms. So that's a 12-year arrangement. The lease commencement date is February 1, 2016. Entity Y must pay entity Z the monthly rental of INR 10,000 upon execution of the lease. On day 0, I'm going to pay 10,000. And then there's a lease incentive of 50,000 rupees, which I'm going to receive. Entity Y has also incurred INR 10,000 of initial direct cost, which are payable on February 1, 2016. And then the present value of all the lease installment, which I need to pay, initial lease liability is 8,50,000 rupees. So how would lease company measure the initial right of use asset? Okay, that's the question. So there are several information is what is being made available to you here. So this arrangement is a 12-year arrangement. I've entered into this arrangement on January 1. And then starting from February 1, on the date of the arrangement, I paid 10,000. Then I've received an incentive of 50,000. And then, I'm also going to incur a cost of 10,000, 1,000 as the initial direct cost. And the standard, and the question is given you what is the present value using your incremental borrowing rate, which is what I said is 8,50,000 rupees. So how do you compute your right of use asset? So if I go to the next slide, this is how you're going to compute your right of use asset, which is to say that 8,50,000 rupees, 8,50,000 rupees, and plus 10,000 rupees less 50,000, which is the incentive which you have received. and hence and plus and less plus 1000, which is the direct cost which you've incurred. All of that put together is your initial direct cost, is your right of use asset, which is 8,11,000. Yes, Pratik, very well done. Your answer is also correct. So that is what is 8,11,000 as your right of use asset.
And Sandeep, Tanvi is asking question. Tanvi, you can start your video and audio and ask the question.
Sir, I just wanted to know.
Yeah.
Behind including only the variable payments linked to index and rate are included. Why not others?
But the others are not included because you not have the ability to forecast them today, right? So if it is linked to an index, the index is being traded today. So you know what is the rate today, okay? And we have an example on that, and I'm going to talk to you about that. But if there are other variables, which keeps on moving every time, right? If they keep on moving every time, you can't determine that today, but it's adjusted at every measurement date based on that variable movement at that particular date. But you don't know at inception. You will use it with, if it is variable with reference to an index, right? Then you will give respect to that index and you will compute the lease liability. Yeah, Tanvi, is that clear to you?
Tanvi?
Okay, let's move forward. So I'm going to move forward to the next slide, slide number 8. Yes, in slide number 8, in the, I think, so when you look at the initial measurement of lease liability, if the lease payment depends on a rate, which is LIBOR, then it will be included, right? And the lease liability, and if the LIBOR is, let's say, 2%, then it will be assumed that the payment will increase by 2%, and that is how you determine the lease liability, which is how it's going to get computed. So if you move Furkan to the next slide, yeah. So I think there has been so this, when you look at this, essentially entity L enters into a lease for 10 years with a lease single payment payable at the beginning of each year. The initial lease payment is INR 100,000. Lease payment will increase by the rate of LIBOR each year. At the date of commencement of the lease, LIBOR is 2%. So if you look at this, LIBOR stands for London Interbank Offer Rate, right? It's a interest rate index which is being used by banks across the world in a way to enter into variable rate lending arrangement. Assuming that the interest rate implicit in the lease is 5%, how lease liability is initially measured. So if the interest rate is 5% and I'm going to pay lease payment is 100,000 and it is going to increase by 2%, and that's what we were trying to say. If it is 2%, it's going to increase every year. And if you go to the next slide, Furkan, there was a detailed computation. Yes. So if you see here, it's a detailed computation, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 10 years. And every year I'm going to 2%, which is the index, I'm going to factor it right now, right? And because that is something which the information is available to me to determine what is the lease liability. So 100,000 in year 1, 102,000 in year 2, 104,000 in year 3, and so on and so forth. I'm going to use all of that, and then I'm going to discount it by 5%, and then the answer will turn out to be 8,80,887 for you to determine your lease liability. So you understood how do you compute a right of use asset, and how do you compute a right of and how do you compute the obligation related to that right of use asset. It is not necessary that on day 0 the right of use asset and the obligation will stay the same, because it is depending upon the cash flows, that whether if, let's say, you made an advance payment already, right, then it will not appear in your obligation anymore, but it is going to get captured in your assets, from that perspective. So you got to be mindful and focus on what information has been provided, and it's not necessary that the asset and the liability will be the same on day 0. It will depend upon the information or the contractual arrangement between parties to the contract for you to determine the right of use asset and obligation. Now, once you have determined the right of use asset, then you need to amortize that right of use asset over its useful life. And similarly, the obligation is what you need to unwind that obligation. So you will end up making a payment every month. I'm making a payment, and then I'm going to record the interest cost on that obligation every month, by way of unwinding of that liability. So in the P&L, now you will have two charges. One is the amortization cost and the interest cost, unlike the previous standard where I only had rent expense, right? That rent expense is no longer going to be there in the P&L. The rent expense is now divided into two components, which is amortization cost and the interest cost. So that is how it is going to change. The rent expense will change into interest cost and the amortization cost. And that's very, very important, because this will change the EBITDA of the company, which is earning before interest, tax, depreciation, and amortization. Your EBITDA may go up, but your earning before interest and tax may also go up, and earning after, which is PBT, that may also be substantially different than what it was previously, because the new accounting model essentially results into front loading of your expenses in the later part of your lease liability. The interest cost will keep coming down, as a result of which your P&L will benefit in the later part of the lease life cycle, whereas the earlier part of the lease life cycle, your P&L will be unduly burdened compared to the previous model. And hence, the new accounting is fundamentally going to change the way balance sheet has been accounted for and the way it's represented in the P&L, from that perspective. So Furkan, if you move to the next slide. Okay, there are certain exceptions, exemptions which you get on recognition. These are short-term leases. So if there is a lease arrangement where you've done for less than 12 months, the standard gives you an option not to account for them as lease arrangement under the standard. Similarly, if you are doing a leases of low value item, you can do an accounting policy choice and not account for those leases of low value item, again as part of the standard. These are certain recognition exemption, and then there are a lot of transition options which are given. This is only been given to facilitate the implementation of the standard. However, certain disclosures may still be required. So if we move to the next slide. Yes. So then there are several whole host of other component which you need to consider from a standard perspective on slide number 12. Yes. So when you look at the whole host of stuff.
Sandip, Furkan this side.
Yes.
So Sandeep, request if you can share a couple of examples, practical examples around, the low value asset, which are generally being used in the corporates and are not being, considered under Ind AS 116.
Right.
Is there any value which we consider as a parameter, or something else which is being considered as a parameter to define as low value asset?
Correct. So unfortunately, the standard, we've decided not to put any quantitative threshold. So there is no quantitative threshold which has been specified in Ind AS 116. The company can define an accounting policy choice. So define that quantitative threshold. And again, it has not been defined for any particular asset category. So again, you can define, for a quantitative threshold. So for example, if you entered into a lease arrangement, say for assets where the rental expense are say less than 5,000 rupees per month, or the total value of right of use that asset is say 50,000 rupees, you may be able to define a quantitative threshold and then say that I will not do accounting for that, as these are leases of low value item. But again, we've looked at the materiality. You have to look at in isolation, and then also you have to assess materiality in aggregation, right? So if you've done, let's say, thousands of such transactions of low value item for a similar asset of the type and nature, then you may have to evaluate that carefully to say that can I take the exemption of low value item. Let's say you purchase 10,000 chairs and all the 10,000 chairs are purchased on lease arrangement and each individual chair only cost you 10,000 rupees, right? Then possibly you will have to account for that as a right of use asset and a right of use obligation. But let's say if you only purchase 5 such chairs totaling to 50,000 rupees of your lease obligation, then you may decide to say that these are leases of low value item and I won't do any accounting for that. And I will only, of course, you have to do end of the day, cash will get paid out. So you will go to record expense as the cash will get paid out. And similarly on the short-term leases, let's say many companies do leases for 11 months. Let's say I'm going to lease my house property for 11 months. If you're doing it for less than 12 months, you have a choice to in a way look at it for less than 12 months, from that perspective. So all of that is available as a recognition exemption, from that perspective for you to assess. So when you look at the transition approach under the standard, there are two type of transition. If you move to the previous slide, Furkan, can we move to the previous slide? I think there are a bunch of things. No, okay. There are a bunch of things which were coming. Other items. What happened to that slide? I saw that slide. Yes, this one. Yeah. So we're going to talk about there are a bunch of things which is important before I jump on to the transition. So lease and non-lease component. Now this is a very important change in the standard, right? Which is to say that are there non-lease component in the standard? Non-lease component means that so let's say you're taking a property on lease, and as a result of property you're also getting maintenance by the lessor. The maintenance cost is incurred by the lessor is a non-lease component, right? Now the standard gives you a policy choice to either separate or decide not to separate the non-lease component. That's a policy choice which you need to look at on day 0 and then follow it. If you decide to separate it, then the process of separation is also not simple. You got to ascribe fair value to each of those component of that lease and non-lease, and then determine that what should get allocated to the lease component and what should get allocated to the non-lease component. Again, you have to do a cost benefit analysis, that whether you are more concerned with the balance sheet bloating up your balance sheet, or you're more concerned on the P&L presentation, and accordingly I think you will achieve your desired outcome. Similarly, you got to look at the lease term. That again is a very, very important determination for you to determine the total ROU asset and the obligation. So the lease term is normally the non-cancelable period, and all of the period where the renewal option is in control of the lessee is what you need to look at as the lease term. Similarly, discount rate we talked about, which is nothing but the rate which is implicit rate in the lease, or if it is not available, then it is your increment rate of borrowing. Lease payment is what you will end up making the payment. You will do a reassessment of the lease liability if it is linked to an index, as and when that index change, as and when there is a change in the contractual terms, you're going to look at that. Economic life is important for you to amortize the ROU asset. Ordinarily, you're going to amortize the ROU asset over the lease term, or a life which is shorter than the lease term. It will not go beyond the lease term. So it has to be a life which is lease term or shorter than the lease term. You may also be required to impair your right of use asset. Now, a lot of times you're seeing a lot of the companies, right, which are having a lot of these retail stores, and you've invested, and now suddenly there are no customers because of the pandemic. So you may have a situation of impairment also on your right of use asset. Similarly, if there are changes to the terms and conditions of the lease arrangement, you got to evaluate the lease modification accounting to say that is this a new lease or is this a continuation of an existing lease, and then accounting guidance needs to be dealt with accordingly. You've got to appropriately look at the lease classification from a lessor perspective, whether it's a finance lease and an operating lease, and the accounting will have to be dealt with from a lessor perspective. But from a lessee perspective, the lease classification essentially doesn't matter. Only thing it matters, which is a short-term lease. If it is a short-term lease, of course, your policy choice not to account for that as a lease arrangement, and or if it is an item of a lease of a low value item, Similarly, initial direct cost, any cost which is incremental in nature, is what you need to capture and capitalize along with the ROU asset, which needs to be amortized over the period of the lease term or the useful life of the asset. If you're doing sublease of the asset, again, there are complex guidance for you to evaluate that. Is there a sublease, and then how do you account for the sublease arrangement? There are sale and leaseback transactions. So some of these accounting have fundamentally changed, but I don't expect you need to be bothered with such complexity for your purpose. I think if you were to focus on fundamental thing that, if I were to look at, lease arrangement between, so first is this a lease which is to identify, is there an identified asset, and is there a control which I have acquired as a result of that arrangement? And what is the meaning of an identified asset? Is it implicitly or explicitly identified in the arrangement and with no substantive substitution right available to the lessor? And then when I say control, am I deriving the entire benefit, or I have the ability to direct the use of the asset to others? So if you look at all of this together, that becomes a lease arrangement. If that's a lease arrangement, I need to then determine what is my ROU asset and what is my ROU obligation. ROU asset is nothing but what you're going to pay as your lease life, as your rentals or charges the entire duration of the lease. And then you got to discount it to the present value. You got to use the discount rate. You got to increase it by the direct cost which you've incurred, reduce it by any lease incentive as provided by the lessor, and add it for any dismantling charges or restoration charges if you have to incur at the end of the lease term. All of that results into your right of use asset. You got to amortize that right of use asset ordinarily on a straight line basis over the lease term or over its useful life, whichever is lower. Then you're going to look at your lease obligation. I'm going to determine my lease obligation and discount it again to its present value. And then as you're making the cash payment at every payment date, you're going to unwind the interest rate and going to charge the interest to the P&L. And eventually at the end of the day, the lease asset will disappear and the lease liability will disappear from your financial asset. You got to take care of a lot of accounting policy choices which are available in the standard for you to implement this in any given situation. So then there are several of the transition options. So if I just go back to the previous slide, just for one minute on the previous slide, and then we can take questions on slide number 12. Yeah, so there are certain transition options, which is a full retrospective approach. You can do a full retrospective approach. So let's say if this standard has become mandatory for companies from 1st April 2019, you're going to apply this leveraging the full retrospective. So whatever the lease arrangements which were outstanding on the date of transition, you will go back in time and you will recompute the right of use asset. You will recompute the obligation as if this was always in force. You were always following this. Let's say you don't want to do that, and the resultant difference in step one will go to the retained earning. You don't want to do that. You can do a modified retrospective, which is the right of use asset is computed retrospectively, but the liability is computed prospectively with changes again going to your profit and loss account. You can also do modified retrospective. There are two approaches in modified retrospective, 2A and 2B, whereas right of use asset can equal to lease liability, where you don't need to restate the comparative period and there's no impact on opening RE. Whereas you look at a single approach, there's a, from a finance lease perspective, there's a single approach of right of use asset equals to your current value or previous gap on transition date. This means there's no impact. Basically, from a lessor perspective, there is no impact on the date of transition in a way, and all of this has to be accounted for on a prospective basis from a lessor perspective. However, from a lessee perspective, it can have significant impact on transition because your existing ROU asset, existing obligation needs to be recomputed, and if you have a lot of asset, as I said, then the accounting charge under the new arrangement is front loaded. What does that mean? That your retained earning will get debited on the date of transition, and you may have the benefit of that by way of lower lease charges in the future period. So essentially that's what this whole new standard Ind AS 116 is all about. So we're going to open it up for questions, and I'll be happy to take questions from Any of you?
So Sandeep, Furkan, this side, the first question is from my side.
Yes.
This is beyond Ind AS 116, more practical in nature. So practically, how big or cumbersome this task of transition was, especially for bigger organization who might have more than thousands of leases practically going on. The global organization, how they have dealt with it.
Yeah. So the first challenge which the companies had to deal with while dealing with the transition um, is to make inventory of all lease arrangements. Now that itself was the fundamental challenge which we experienced with a lot of companies, to say that, do I know exactly where all, how many lease arrangement do I have? Because up till now, I was making a rent payment and I was debiting that to the P&L, and hence I wasn't bothered. Like, if you look at your fixed assets, right, you create so many controls in place to ensure that you have full inventory of all your fixed assets. But that was not the case for operating lease assets, because they were never on your balance sheet. So the controls which were in place to ensure that all the assets are properly accounted for, or exactly how many arrangements you have. Because let's say, I have multiple offices in India, and there is a local office and somebody has taken another office. I may not be knowing at the headquarters as to how many lease arrangements I have. So the first challenge was to make an inventory of all leases which are available to a company, right? Then the second is that, how do you identify the lease term now? So up till now, agreements were loosely defined. It is 12 months, it is renewable at mutual agreement, or so on and so forth. So you now need to identify all of these attributes which I just said, whether what is the lease term, how much is the rental payment I need to make, how do you determine the discount rate which I need to apply to that arrangement, and then once you made an inventory, then you were geographical issues. So if you've taken an asset in India, you want to discount rate which is prevailing in India, but you've taken an asset in America, you can't apply the same 9% rate to discount the asset in US as well, right? So you got to again use the local rate which is prevailing in US for you to discount that. So multiple discount rates which were there. Then there was this issue of this foreign currency, right? For companies like Indigo and others, where they take all these airplanes, right, on leases, where they have to pay rentals in foreign currency. Now there's a huge exposure of foreign currency fluctuation, which up till now was never exposed in the balance sheet of those companies, has also now been accounted for. So there are multiple things which companies have to take care of, and which started right from building the whole inventory of all the leases, and then making all of these decisions, making a lot of these policy choices, and then putting the right systems and processes in place. And it is not only a one time, because now let's say on 31st of March, you enter into a contract to renew a lease. Up till now, I was not bothered because there is no P&L impact, because just because I have renewed a lease. But let's say if you renewed a material lease and it is for 30 years, suddenly your balance sheet will going to get bloated on 31st of March, because on 31st of March now you have to account for your assets and liabilities. So it has fundamentally changed the way the accounting for leases were being done historically compared to now what is required to be done under Ind AS 116.
Thanks, Sandeep. Praveen, we can open it for participants.
Right. So Sandeep, we have a question from Purvangi. Purvangi, if you can start your video and audio and ask your question to Sandeep.
Yes.
Hi. Okay. So as you said, we would be doing an inventory of all these ROU assets. From an auditing perspective, would we need to do a physical verification of these ROU assets, which the client must have created a list and as such?
Of course, as you look at any asset, how do you do audit of an asset, right? When you look at an audit of asset and audit assertion, you look at completeness, existence, accuracy, valuation, and presentation, right? So whether the list is complete or not, which is, and then when you say is the asset is in existence or not, and then you say is it accurate or not, right? And then is the valuation is appropriate or not, and then the related presentation and disclosure. So you got to look at all your audit assertions, right? If you're looking at auditing such a balance sheet item, because it is going to be a very material number, depending upon the type and size of the company. If it is a material number, of course, you got to ensure that company has mechanism which are in place, which is similar to what you will do for safeguarding of your physical assets, right? So it is another physical asset. So what are the controls, mechanism, listing of those assets, all of that now required from an internal control perspective for those operating lease assets, which are now recorded in your balance sheet. So that these are fundamental challenges for implementation of the standard. Okay, awesome.
We have a question from Tanmay. Tanmay, if you can start your video and ask your question. Tanmay.
Till the time, I'm going to take few questions. I see one from Nishta on the chat box. Is there any difference in accounting treatment as per Ind AS 16 and IFRS 16? There is no difference in accounting between Ind AS 116. So, we've said it as 116 and IFRS 16. There is no difference in accounting between Ind AS 116 and IFRS 16. These are all verbatim the same. In fact, there was from a lessor perspective, if you remember, Ind AS 17 actually had a carve out from the international standard where the straight lining of lease rental were not required. That has also now been introduced for lessor as well. So that's one fundamental change for lessor from Ind AS 17, that they also now need to do straight lining of their lease income, which was done away with in Ind AS 17 as a carve out from the international practice. So that carve out has also been eliminated. So practically the IFRS 16 and Ind AS 116 is same in one and all respect, from that perspective. So there was a question on, hi, since you brought up airlines, I wanted to ask if there is any difference between accounting of airlines for a normal aircraft lease and a wet lease. So this question is, I think, Nikhil, you're trying to say that is between a dry lease and a wet lease, and wet lease, as you know, comes along with the maintenance as well, right? And there can be a possible difference between a dry lease and a wet lease, and the difference is that in a wet lease, your non-lease components are also embedded as part of the arrangement, which is this whole maintenance arrangement, which is the non-lease component. And as I said, the standard gives you an accounting policy choice to separate the lease and the non-lease component. If you decide to separate the lease and non-lease component, then possibly answer will be the same, whether it's a dry lease and a wet lease. But if you decide not to separate the lease and the non-lease component, then your balance sheet can change significantly, and same can be an impact on the balance sheet as well, because you will then end up grossing up a higher amount and similarly amortizing a higher amount, whereas there will be no direct charge on account of maintenance payment, which you will be making to the lessor. It will all come through by way of amortization of your right of use asset, and will also results into recognition of unwinding on interest cost on such transaction. So I hope that answers your question. So I think there's another question which I mean, anybody wants to just ask a question, just kind of switch on your video and ask me a question.
Sandip, Praveen, they said, can we exit from the screen share if that is not required anymore?
Yes, please.
All right, perfect. Guys, you can start your video. Ravi, you have a question. You can ask your question to Sandip.
Sandip, so Praveen, we have that poll also. So do we want to take a go to poll and then come back to Q&A?
Right.
Yes,
so guys, let's get to the exciting poll part. So I'll share my screen to show you the rules and some of the. All right. I hope you guys can see my screen. So now we are entering to the quiz: learn, think, and win. These are some of the terms. Answer 10 questions. You'll get 10 minutes on. Sorry, this is a mistake. This is a typo on Ind AS 116. We'll be asking questions. So each question will be of 1 mark. Winners will be decided on the basis of fastest finger first, and we'll decide the final winners. There will be 3 winners. The first prize would be the Hugo Boss pen of worth rupees 3099, and then the second prize is Bluetooth speakers worth rupees 2099, and third prize would be a backpack, again worth rupees 1099. So guys, we'll be sharing a link on the chat box, and yes, we'll be sharing the results. Again, we'll go to the Q&A, and at the end of the webinar we'll share the results, and we'll just share the link in the chat box. Just give me a second. So I've shared the link. Please open this link. You'll get 10 minutes, And in the meantime, if you guys are done, then we have some questions which we have already asked, and we can address, Sandeep can address those questions in the meantime. All the best to everyone.
So we're starting at 12:02, right, Praveen?
Yes, 12:02 we have started. So in the next 10 minutes, 12, we will stop the poll. So in the meantime, Sandeep, could you, I'm sure you're also, participating in the poll. So once you're done, we can, you can address some of the questions which people have asked.
Sure. Let them finish it. I think otherwise they'll get distracted, right?
Sure.
So just give them 10 minutes.
We have got all the entries. We have got some of the.
Have we got answers, Praveen?
Yes, we have got answers, and we have also got winners. But let's take Q&A, and then after some of the questions, we can announce the name of the winners.
All right. Very good. Very good. So I'm going to take a few more questions. As I see here, I have a question on sublease from Vishal Jain. And is it necessary for an intermediate lessor to add a profit element to be charged to final lessee? Example, if lessor charges rupees 100 to intermediate lessor and this amount is reimbursed by final lessee to intermediate, will it qualify as I mean, essentially, there's no necessity for you to have a profit element. If you were to do a sublease arrangement, it's absolutely up to you. But fundamentally, there has to be a commercial substance in the arrangement that if you are actually doing this, why are you, if you're not making any money in the whole process, right? What's the purpose of then you doing the sublease of the asset, right? There's no reason for you to do the sublease of the asset or enter into this whole commercial arrangement itself, right? And hence there has to be a part of profit element. Even if there's no profit element, I think it will still qualify, depending upon the substance of the arrangement. It will still qualify as an accounting. So I think, can you please highlight some changes which have been made applicable to Ind AS 116 due to COVID pandemic? There are many changes which have been introduced in 116, but those changes, fortunately, I think are not applicable for November 2020. But some of the changes, for example, that if there is a modification in the lease arrangement because of the COVID pandemic and the modification accounting is slightly complex in 116, and it's also in a way time consuming, so to say. So you have to change your existing RO computation of existing ROU asset and obligation, your amortization principle changes. It could result into a gain or loss on the because of the modification. So in a way, the standard then permits you not to do all of that and simply account for the amendment as a separate kind of a transaction and deal with that appropriately. So that has in a way has come as a relief for many of the companies, which, let's say, I don't have to pay rent for a period of 3 months. There's a rent holidays now been agreed between lessor and lessee because the stores were closed or there was a lockdown or so on and so forth. Ordinarily, the modification accounting for any change in terms will require you to go back and change the ROU asset and liability and kind of deal with that. But the pandemic in a way has given some relaxation. The standard setters have considered this and given you the relaxation.
Sandeep,
yeah.
We have Vishal who wants to speak to you.
Sure.
So Vishal, please go ahead, Vishal. Unmute yourself, start your camera. Vishal Jain, are you there?
Yeah, so Sandeep, on that sublease, so if the question specifically mentions that the final lessee has to reimburse the actual amount of the rent to the intermediate lessor, then still will it qualify as a sublease?
Just give your question, full question for everybody's benefit. What is it you're trying to ask?
So suppose there are 3 parties in a contract, A, B, and C. A is the lessor, original lessor, and it leases its asset to the B, who is the intermediate lessor, and then again in turn B leases it to C, who is the final lessee. Mm-hmm. And B pays to A rupees 100, and then B gets it reimbursed from the final lessee, same amount rupees 100. No profit element is added to that. So will it qualify as a sublease? Because if the question specifically mentions here that the amount is getting reimbursed by B to A.
Correct. And are you saying this all A, B, and C are all identified together at about the same time?
Yeah, at about the same time.
So then essentially, then there is no lease. This is essentially an agreement directly between A and C, right? Then B is just an agent. So
Okay.
if B is just acting as an agent and all three parties have come together to enter into this arrangement, B is nothing but an intermediary, as you're saying. It's not, then there's no principal. There's not a principal arrangement between A and B, and then B has decided to do it with C, right? This has happened all together, identified at inception itself. So essentially, B will not require to do lease accounting. If there is B is not making anything, B may only be required to make certain disclosures, and depending upon what kind of balance sheet obligations they are taking in terms of default. So for example, if C were not to able to pay rent to B, whether B is still required to pay rent to A, right? In the eventual default by C. So we'll have to look at the contractual arrangement to determine if there's any obligation which needs to be recorded in the balance sheet of B. Otherwise, B is largely acting here as an agent, and then there's no principal between A and B.
Yeah, agreed. So just to ask one more question on that. So if the timing of the contract is different, then will it qualify as a sublease if the timing is changed?
Absolutely. As I said, if the timing of the contract is different, if there is an independence in between for B to decide whether I want to sublease to C or to D or to E to or anybody else, right? I think then these are two independent contractual arrangements. You look at the commercial substance, and then you may end up recording gross right of use, asset and liability, and then subsequently lease modification, lease sublease accounting.
Okay, got it. Thank you.
Okay.
All right. Thank you. Prateek, please, you can ask your question. Go ahead.
Okay.
Prateek, please.
I have until the time Prateek comes up. I think I have. I'm just going to pick up this.
Hello.
Okay, yes, Prateek. Hi.
Pratik here.
Hi, Prateek.
Hi. I wanted to ask if there is a termination of lease after like 2-3 years of the lease term. During the lease term, if there is a termination, what would be the impact on PL, statement of PL?
So once there is a termination, you're going to close out your lease asset, you're going to close out your lease liability, and the resultant difference will go into P&L.
Where will it be disclosed? In other income, or it would be set off with rent expense?
There is no rent expense, right?
Interest.
You'll have to look at the geography in which it will go into the P&L. Ordinarily, it should be part of your operating P&L.
Okay.
Yeah.
Thank you.
Sandip, shall we take some more questions?
Yeah, we can take one or two
right.
more questions, and then we can wrap it up quickly.
All right. So Ravi has a follow-up on Prateek's question, and then Tanmay will go last, with you, and then we'll announce the winners. So Ravi Teja, please go ahead and ask your question.
Hi, Sandip.
Hi.
Sandip, just Prateek was asking that.
Sorry, Ravi, I can't see you. Have you switched on your video?
You can start your video, Ravi.
Is it visible now?
Yes, better.
Yeah. So I have a question, Prateek was saying that that when a contract was terminated for a certain period of time, suppose as on 1/4/2019, like on the transition date, I have recorded certain assets and liabilities in my books, lease assets, and this got terminated due to commercial reasons. But how would be the accounting treatment? Like initial adjustment we are making to the reserves, right? Even after the subsequent termination, should be given to effect to the reserves or to the P&L?
So any initial transition to reserve is a one-time accounting, okay? That you only need to do on the date of transition. Any subsequent changes in the lease arrangement, whether it's termination, whether it's modification, whether it's renewal, all of that, any accounting impact of that, all of that has to be recorded either through balance sheet or through P&L. So many times, let's say if there is a change in lease liability, right? Because of the change in index, right? That change in lease liability because of change in index is going to be accounted for by way of grossing up of ROU asset and the lease obligation. So there is no impact on the P&L just because there is a change in the lease liability, right? However, if there is a termination subsequent to your transition to Ind AS 116, and there is now you have to close out all your lease asset and lease liability in relation to that particular asset, the resultant impact, if there is any, it will go to profit and loss account, even though the original transition impact, a substantial portion of that may be recorded to the retained earning. You are not allowed to go back and draw upon the retained earning charges for any subsequent impact on your lease arrangement.
Thank you. Thank you, sir.
Awesome.
All right. Tanmay, go ahead. Last question for this session. Tanmay, please go ahead and ask your question. Start your video if you can.
Hi, Sandip.
That'd be great.
Hi.
I had a question specific to the poll here regarding the option for the lessees to renew their lease. So if I just repeat the question, this is A Limited has entered into an arrangement with B Limited where the latter has agreed to lease out laptops and accessories for 12 months. And the agreement provides the lessee A Limited an option to renew the lease for 12 months more. And the lessee is reasonably certain to extend the lease. Can the lessee opt for short-term lease exemption? So could you shed more light on the option
So
that is available
essentially
to
what
the
we're
lessee?
trying to say that if at inception you have done, so what was the short-term lease exemption was 12 months, right?
12 months.
But
Yes.
here you entered into an agreement for 12 months and you also reasonably certain to re-exercise the renewal option, right? So that means that the lease term is actually not going to be 12 months, but actually is going to be 24 months, right? Now, if the lease term is going to be 24 months, then the short-term lease option is not available to you. So you have to look at the lease term, and lease term is nothing but the non-cancelable period plus the period for which as a lessee I'm reasonable, which is in my control, and I'm reasonably certain to exercise that option. So that then becomes your lease term, and whatever then your lease term is, if it is more than 12 months, then you are not entitled to exercise the short-term lease option.
Okay. Understood.
All right.
Thank you.
So the renewal option or the lease becomes very, very important, and the fact here that the question suggests that you are reasonably certain, right? Because you are reasonably certain to exercise. If the question were to say that I don't know that whether I will exercise or not, then it becomes, then one could have taken a position that it is only 12 months. Right? Okay.
All right. Thank you so much, Sandeep. Thank you everyone for asking questions, and now it's time to announce the results. So may I do the honor, Sandeep?
Yes, please go ahead.
All right. So I'm, also, sharing the name with everyone in the chat box. The first winner is Aditya. The second winner is Anik Jain, and the third winner is Anand Singh. All of you have got 10 on 10, and we have to decide on the basis of the timing.
Can you guys switch on your videos if you guys are still here?
Aditya, you can switch on your video. Please, Nitin, please unmute Aditya and Anik as well as Anand Singh. Any one of you?
Hi, sir.
Aditya, yeah.
Hi. You're Aditya?
Anik.
Anik. Hi, Anik.
He got the second prize.
Hi. So, Anik, you want to share something about yourself? So, what do you do?
Sir, I have finished my Group 1 of CA final, sir. I am currently pursuing Group 2.
Okay. Okay. And
Hello,
you will appear for November 2020?
Yes, sir.
Okay. Okay. And what are the papers there in Group 2?
In Group 2, we have costing, direct tax, indirect tax, and elective paper, sir.
Oh, which is elective. When you have you taken accounts as the elective paper?
No, sir. Economic laws I have taken.
Okay. 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 And despite that, you get 10 on 10 on leases, huh? Fantastic. Fantastic.
Thank you, sir.
So you've been learning Ind AS 116 or?
Yeah, sir. Actually, in the May attempt, there was no Ind AS 116. So I had an interest to go through the session and understand the concepts of Ind AS 116.
Awesome. Awesome. No, I think I'm really happy. I hope the session was useful for you in terms of reinforcing some of your concepts.
Yes, sir. Thank you for the session, sir.
Thank you. Thank you, Ani. Thank you.
Thank you for the
Aditya.
Hi,
Anand.
Anand?
This is Anand Singh. Yes.
Hello, Anand.
Hi, Anand.
Yes, sir. I'm also appearing for the both groups in November 20.
Okay.
Just 2 days back, I have revised this Ind AS 116. And also the question that Tanmay asked was almost the same question that is there in the study mat also.
Right. Right.
Yeah.
And was the session useful for you?
Yeah, sir. Obviously.
In terms of understanding some of these concepts better?
Yeah, sir. Especially that question that Fukran asked about the Fukran asked about the what was that? How will we implement that Ind AS 116? Yeah, in the practical terms. That was very useful. Yep.
All right. Awesome. Thank you. Thank you, Anand.
Aditya,
Which paper is left for you? Have you cleared all? Which paper are you doing in CA final?
So both groups. I'm preparing for the first attempt. So this is my first
Awesome, awesome. All the best. All the
Thank you, sir.
best.
Thanks a lot.
Okay.
Aditya, could you start your video?
Aditya, you are on mute.
Aditya, Nitin, can we unmute Aditya?
Hello. Good evening, sir. Good afternoon, sir.
Hi, Aditya. Hi. Good to
Hi,
see
sir.
you and many congratulations.
Thank you, sir.
And tell me something about yourself.
Yeah, sir, I'm in CA final and yeah, preparing for November this time.
Both groups?
Yes, sir, both groups.
Okay, awesome. You know, I can see you're studying and working very hard, you know. So how many hours you putting up to your study every day?
Sir, no, not that much now. As in March, what was at what pace I was. Now it's not that much, but yeah, still doing a bit. Let's see how it goes.
What, 10 hours a day?
Around 8.
I used to study 14 hours, huh?
Yeah,
Don't
sir,
underestimate. Don't underestimate the effort it takes.
No, I used to do at least 12 hours a day before lockdown, but then since then the momentum has lost, and let's see.
Right. And my recommendation to every one of you is, again, don't underestimate, don't believe that you know everything, and try to revise as many times as possible. The more revision you do, the better you'll become, right? And look at, again, all the past question papers. All of them are very, very important. Practice them, and I'm sure all of you will do well. All right. Okay. Thank you all. Thanks a lot for all your participation. Thank you.
Everyone, a couple of more things. We'll be again coming up with our next webinar on 10th of October. I request you all, Sandip is taking his time out and sharing his insights with you. I request you to please share, about these webinars with your friends as well. Please join us on 10th of October again. And, we'll be covering a couple of more Ind AS sessions before you go for your exams. All right. Thank you so much, Sandip, for your time. And thank you, for this exciting session.
Thank you. Thank you. Take care. Bye-bye.